to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make you a little money. My job is not just to entertain, but to teach, put it in context. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Not that long ago, pretty much everybody assumed that the next non-tech stock to cross the $1 trillion threshold would be the stock of Eli Lilly. Why not? They've developed a weight loss and diabetes wonder drug with incredible prospects. Oh, but this market plays many tricks on us every day, including today, where the Dow dipped 126 points, S&P declined 0.13%, and the Nasdaq edged down 0.07%. The anomaly this time, it looks like the next $1 trillion stock won't be Eli Lilly. If anything, it's more likely to be the stock of J.P. Morgan, a bank. Right now, Lilly's market capitalization is roughly $724 billion, but J.P. Morgan's at just over $850 billion, up 29% for the year. Meanwhile, Lilly's down so slightly. To me, this is a monumental move, people. A bank stock putting on that kind of market cap right on the eve of an incredibly important Fed meeting, where everyone seems to be expecting a quarter-point rate cut, despite a recent uptick in inflation. What's going on here? First, to understand the $1 trillion barrier is really hard to cross. Right now, there are only 9 members of the club. NVIDIA at an astonishing 4.2 trillion. Then Microsoft close behind at 3.8 trillion. Apple, 3.5 trillion. Alphabet, which just crossed the $3 trillion threshold. Amazon at $2.5 trillion. Meta at $2 trillion. Broadcom at $1.7 trillion. And there comes Tesla again, $1.4 trillion. And at last, hanging on by a thread, is Berkshire Hathaway at $1.06 trillion. They're all more or less tech companies except for Berkshire. Oh, I thought Lilly would be next. Look, the GLP-1s are just that huge. Today, Lilly announced plans to build a $5 billion manufacturing plant in Richmond, Virginia. As we told members of the investing club this morning, this facility marks the first of 4 American plants for targeting cancer and autoimmune drugs. They also need another plant for the pill version of the GLP-1 drug, which hasn't been approved yet, but could turn out to be much bigger than the current injectable version of the drug. Bye. When you consider all the indications for this thing, including the already approved chronic weight management, diabetes, and obstructive sleep apnea indications, and the fact that it might be approved for heart failure, hypertension, and even chronic kidney disease, well, you can see why the betting line favored Lilly to cross the $1 trillion finish line first. But Lilly's stock has been stalled, in part because it has a vicious, some would say desperate rival in the form of Novo Nordisk, which is doing quite poorly, but has a very good compound. Plus, you aren't supposed to buy drug stocks if the Fed's going to cut interest rates. They are toxic at this point in the business cycle because it should accelerate the economy, so you should avoid so-called safety drug stocks. And, of course, the president seems to be hostile to the industry. They're building plants in America. That could help Lilly. Meanwhile, like a horse that's bided its time but is now at the far turn, J.P. Morgan stock is putting on a run for the roses move that's as breathtaking as it is obscure. What's propelling it? First, it's not the only bank that's making a ferocious move. Citigroup, for example, which had been in the doldrums for so long, just crossed the $100 mark. What a 43% rally for the Citigroup stock. That's a remarkable move in itself. Wells Fargo and Bank of America have been climbing, too, up more than 15% each. The so-called investment banks, Goldman Sachs and Morgan Stanley, have been running like crazy, with Goldman up 37%, Morgan Stanley up 24%. But if you ask me, the real rocket fuel, it's the expansion of what we call the price to earnings multiple, or what we will pay for the company's earnings. Right now, people are simply willing to pay more for the banks. We don't talk enough about the PE, price to earnings multiple, around here, a topic to which I spend a lot of time in my next book, believe me, How to Make Money in Any Market. Comes out in 2 weeks because it's just so darn important. See, I don't think people realize that the price to earnings multiple is at the heart. It's the fundament about how stocks trade. The multiple can rise even when the earnings estimates stay the same. That's called multiple expansion. It can move up a stock, or the multiple can stay the same when the earnings estimates rise, which gives you a higher stock price, too. In the case of the banks, it's both. That's right. Both the earnings are going up and the price-to-earnings multiple is increasing at the same time. It's remarkable because we're less than 24 hours away from a Fed meeting that would normally upset the financials if it backfires. And if you want to know what it means for a rate cut to backfire, stay tuned for the rest of the show. Right now, though, the market's saying that the Fed doesn't matter to the bank stocks, which is nuts, because the Fed matters immensely to the actual banks. Now, some of that's because of this multiple expansion I just referred to. JP Morgan stock has been consistently selling for about 14 times its earnings for many, many years, dramatically lower than the 22 times earnings bogey of the S&P 500. But it's been levitating alongside the earnings estimates all year. Now JP Morgan sells for 15.7 times this year's numbers, up from 14. Goldman Sachs and Morgan Stanley have also been making gigantic moves. They now sell at 16.9 and 17.5 times earnings, respectively. It is what we call a wholesale revision, and it's only gaining steam. Now, kudos to Mike Mayo, the uber bullish bank analyst at Wells Fargo, who has a terrific piece out just today entitled "Goliath is Winning." He upped his price targets for all these banks, making it very clear that the capital markets are really getting hot. With some terrific tailwinds like Trump deregulation, even credit quality, which has been remarkably good during this period. His favorite has been Citigroup, which CEO Jane Fraser has rescued from obscurity. Great call. I happen to like Wells Fargo, where Mayo toils, because CEO Charlie Scharf has resurrected this bank, this time from regulatory hardship. That said, JP Morgan's got something special. It excels at so many things, lending, capital markets, trading, and perhaps most important, statesmanship, with CEO Jamie Dimon performing at a level that's rare for any industry. JP Morgan has always been a top-quality bank, but it's now become a fantastic place to work, and its global reach is unmatched. There's a reason its market cap is so much bigger than the other major banks. Can this continue? I have to tell you, if you look at the forward multiple, meaning how much JP Morgan's trading on versus next year's earnings estimates, the answer is a resounding yes, because this one sells for just 15 times the 2026 estimates. That's puny. Goldman Sachs and Morgan Stanley trade at roughly the same levels, but Wells Fargo, Bank of America, and Citigroup sell ridiculously low, around 10 to 12 times next year's numbers. That's not sustainable. It's going to go higher. At the end of the day, the price-to-earnings multiple is the arbiter of what's cheap and what's expensive on next year's earnings estimates, and you're talking cheap, cheap, cheap. So, yeah, my original prediction will likely be wrong. Eli Lilly's probably not the next non-tech stock to cross the trillion-dollar barrier. But, man, what a way to be wrong. I'd much rather have a market led by the banks than a market led by big pharma. The bottom line, I've been waiting for years for the banks to get higher price-to-earnings multiples. They're incredibly important to the broader market. When the banks are winning, it's a terrific sign for the overall trading. Remember, this tomorrow, if the averages take a hit from the Fed because once multiple expansion starts, it's not easy to reverse. We might be okay. These are hard-fought moves, and I bet that they're just at the beginning. Julio in Pennsylvania. Julio.
Hey, boy, Jim. It's Julio here from Pennsylvania.
Great to have you on the show. How can I help?
Hey, I called a few months back about Target. It was at a historical low back then. I picked up some shares. I'm a little underwater, but, you know, the stock's dipping further now with the CEO transition and some tariff noise in the mix. Trying to decide what to do here. What are your thoughts?
Well, the stock's down 33%. Now, I am in a wait-and-see mode on this. Why? Because I want to know this new CEO. I want to know what he's cut out. I don't know whether he's the right guy or not. I said we have to wait and see before I would possibly advise you to think that there's more to buy. And Julio, thank you again for calling. All right, look, when the banks are winning, it's a tremendous sign for the market. Remember that tomorrow, in case the averages take a hit from the Fed. On Mad Money tonight, unsurprisingly, there was so much to discuss with Apple CEO Tim Cook last week that we are airing the next part of my exclusive sit-down from the Corning plant in Harrisburg, Kentucky, where the glass for every iPhone and Apple Watch will be born. You won't want to miss it. Then tomorrow afternoon, we will learn the latest decision on interest rates, and with it being pretty clear that the Fed is going to start a new rate-cutting cycle, I'm going to share with you one of my biggest worries about what could happen. Plus, CrowdStrike had a bunch of announcements from its annual customer conference, Falcon, and I'm getting the latest from the company's top brass, so stay with Cramer.
Don't Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Last Friday, I got a chance to check in with Tim Cook, the CEO of Apple at Corning's iPhone glass manufacturing facility in Harrodsburg, Kentucky. We've been broadcasting that interview over the course of multiple days because when you get an interview with Tim Cook, it's market moving, and you need to see every bit of it. The stuff's priceless. It does also explain some of the big move we've seen in the stock lately. We've got one more piece of this huge interview with the CEO of arguably the best company in the world. Take a look. Did you ever think, Tim, that the role of a CEO would be a global ambassador and also someone who has to try to make peace with India, with China, with the White House? This isn't what you got in this business for.
You know, it's an incredible job, and it's a privilege of a lifetime to have it. The people that I get to work with are just unbelievable. We trust each other, we collaborate with each other, and I can't imagine life without it.
Well, a lot of people, I think, would say when you hear something like, and we heard this in Truth Social, I have long informed Tim Cook of Apple that I expect the iPhone will be sold in the United States, will be manufactured and built in the U.S., not India. Now, that's the kind of thing where you read it in Truth Social, you say, geez, maybe I ought to reconfigure things, right?
Yeah, definitely a motivator. Definitely a motivator. And so what we were doing, Jim, since we announced a $500 billion commitment toward the beginning of the year, we were continually working to come up with more ways to bring manufacturing into the United States. It's not really bringing it back because that manufacturing was not here to begin with, right? And we came up with several things that we could do more of. One was the glass that you saw today, and we're thrilled with how this project is going. Another is stitching together the end-to-end silicon supply chain. I'm really pleased with how that's going. And yet another one that's a little different than both of those is a deal that we did with MP Materials to do rare earth magnets in the United States. And so a lot of advanced manufacturing can be done in this country and be done competitively in this country.
Now, so a shareholder should feel that even though these international markets are so huge, it's okay to make these things here and okay to commit $600 billion. It was a big deal to commit $1 billion in 2017 when we first talked. $600 billion, that's a huge chunk of a country.
It is a huge one, but we're an American company, and we're a proud American company, and we want to do as much in the United States as we can, not only for product that we sell in this country, but for product that we sell around the world. And so, we do have a global footprint and sell quite a bit of product outside the United States.
Well, is the administration keeping track of how much you're spending?
We're in constant communication. We have a very good relationship. It's very positive. And to their credit, they are focused on regulation and trying to decrease the amount of regulation that it requires to build a new factory, to build a new data center, et cetera.
Did the tariffs work in the sense that they are bringing companies back and they gave us a level playing field, which I think you and I would always think if U.S. had a level playing field, we would win?
I think they're a motivating factor for many businesses. And I hope that there are other factors as well. Like, for example, in this factory, what you get a sense of here is it's not just one thing. It's innovation plus cost competitiveness plus quality. It's the sum of all of these things coming together.
All right, well, let's talk about the phones we saw today. There's a sense from the critics that they don't have enough AI. I always think if they don't have enough AI, then why isn't everyone going to Samsung? The numbers don't show that people are fed up with your AI, do they?
There's a lot of AI in the iPhone. And what we do, is try to do things that are in the background for people and then surface them when they're in the app. And so we integrate AI across our operating system. You might come across it in doing something like smart replies or mail summarization. You might come across it if you wanted to do some visual intelligence, like saying, what is this piece of machinery over here or whatever. You may come across it in the future with live translation, right? And so there's all kind of things built in. And then in addition to that, we're working on a personalized Siri that will be available next year. And we are very excited about this.
Will I be able to use a personalized Siri to be able to connect in a way that I do with a Perplexity or a ChatGPT? Will you have to develop that, or after that incredible decision by a district court judge saying, listen, the relationship you have with Google's fine. Yes, they should pay you. Well, the tables turn. A lot of people thought you would have to buy somebody. I mean, but the way I look at it, if that decision, people should want to access your 1.2 billion users. That, to me, it went from you paying them to they paying you.
You can already, because we've integrated OpenAI into the operating system, you can already use OpenAI with Siri. And so that's available today. But there will obviously be a finer integration in the future.
But there are discussions right now about the way to go, I presume.
We are having great discussions. I can't really talk about those in
if
detail.
you did that, you wouldn't be Tim Cook.
Right. And but basically, Jim, I see AI as the most profound technology of my lifetime. It's that stature, and you think about all the things that have happened in both of our lifetimes, that's really making a statement. And so we are all in.
Now, when I look at what you're doing right now, I think that each one of these phones have more AI, but you don't talk about it enough. I don't find out until I own the phone the AI that you have. There's someone who downgraded your stock the other day who said there isn't enough AI in it, but they don't even have it yet.
Yeah, I can tell you that it's all over the applications. It's all over things that you use and where you are, from notes to messages to mail, all the things that you normally use.
Well, I think that I do want to try to figure out what can't be done here. We're not making liquid crystal display, even though Corning does that. I'm not seeing that made here. There are certain parts of this that involve the camera. I'm not seeing that made here. Do you think, the president who says he wants everything made here, is he keeping score and saying, yeah, sure, they got the glass, they got some of the semi, but I want the camera made here. Is that realistic?
There's 19 billion chips made in America already, and we're scaling that further. And so there's significant semiconductor presence in the United States. We have relationships with many of the people that you report on. And so that feels like we've planted seeds and it's growing and doing well. We're also, as you know, continuing to ramp with TSMC in Arizona.
Right.
And this is a very key project.
Now, what we're seeing here, can it be replicated? And I say that we see these gentlemen who've been working here for years, and we think that we see this plan. It's been so many iterations. Is this something that one of Apple's legacies? I know you want healthcare as your legacy. Should it be that you can bring back? I know some places have never even had, but that you can change the landscape of our nation with 600 billion.
With 600 billion, we hope to do exactly that. And so when you think about, we do business with 79 factories across the United States today. Each of these, there's a story behind. There's a story of a community. There's a story of multi-generational workers. There's a story of earning enough to earn a good living. Not just having a job, but earning a good living. And we're very proud to be a part of that.
You should be. I would think, though, that we may not have the education system to do that. Can some of that money be used for education? You could endow, better endowment than Harvard, University of Texas, whatever. I have to believe that you're going to have to do that, too.
It's part of what's behind the thinking behind the manufacturing academy that we put in Detroit, because we want to train small and medium businesses to be in the manufacturing business in America.
Now, the EU, you're not letting, they don't have the translation yet? They're not allowed to? What's going on there?
Yeah, unfortunately, the Digital Markets Act is very difficult to navigate. And so there are several innovations that we will bring to the EU, I hope, over time, but need to be delivered in a different manner than they're delivered in other parts of the world. This is an unfortunate side effect of a very rigid regulation.
What's your message to the administration about how urgent what you're doing is and whether the urgency is felt throughout all of business? Because obviously you're well ahead of everyone else in this country.
Well, we feel good about where we are, and we feel that we can be the ripple in the pond. And so stitching together the semiconductor supply chain will not only help Apple, it will help other companies do more in the United States. And so the bringing rare earth magnets into the United States, that will also help other companies as well. So I hope to be a ripple in the pond here.
And what's your message to young people who feel that AI is going to take their job, that the opportunities for them are not nearly as good as their parents or their grandparents? What do you say to them, Tim?
I think there's always been these moments over time where fear crept into our psyche. We feared the spreadsheet. Some accountants and different analysts feared the spreadsheet, but there's probably more of those today that exist than were there before that. We feared the word processor. I'm not saying AI is like the spreadsheet and the word processor. It's much more profound than that. But I think that there will be great opportunities for young people. My advice is to follow your passion and find something that helps other people. And if you can find the intersection of those two things, following your passion that helps other people, you can earn a great living.
Well, let's leave it right there. Thank you to Tim Cook. Thank you for all your time, Tim. Thank you. Appreciate it.
Thank you.
Tomorrow afternoon, we'll find out the Federal Reserve's next move on interest rates. Like most people, I'm expecting a quarter-point cut because over the past month and a half, we've learned that the labor market has weakened substantially since the spring. But tonight, as we get set to embark on a new rate-cutting cycle, I want to spend just a couple of minutes talking about one of my greatest fears for this market. My biggest worry right now is that once the Fed starts cutting rates, we'll see the same thing we saw a year ago. Yes, almost exactly a year ago to date. Short rates go lower. That's the ones that the Fed controls. But long rates, the long-term interest rates, the ones set by the bond market, soar higher. The rate cuts ended up being totally counterproductive and self-defeating. Let's go through what happened last year because it's the nightmare scenario for 2025. Almost exactly 1 year ago, the Fed blessed us with a generous double rate cut, then followed up with 2 more regular rate cuts in November and December. But almost exactly when the rate hikes began, long-term interest rates started climbing. It was a bond market rebellion. Look at this chart of the 10-year Treasury yield dating back to the beginning of 2024. Last year, as it started to become clear that the first rate cuts were coming, the yield on the 10-year tumbled from north of 4.7% in April to a low of just under 3.6% in mid-September. Crucially, that low was set the day before the Fed announced its first rate cut. And then almost immediately after that cut, the yield on the 10-year started screaming higher. By the end of October, it was at nearly 4.3%. By the end of December, it was just under 4.6%. And it kept going until mid-January when it finally peaked at just over 4.8%. After that, the 10-year yield was pretty volatile, falling quickly as the market sold off earlier this year, and for briefly falling below 4% during the post-Liberation Day washout in April, before quickly bouncing back, then stabilizing the 4.2 to 4.4 range, where it was for most of the summer. It's only this month that the 10-year yield fell below that level, once again in anticipation of another rate cut cycle from the Fed, starting again. We saw the same thing with the 30-year, except the 30-year didn't actually peak until May, and it hasn't pulled back as much from the highs. By the way, the 30-year, just so you know, that's what the mortgages are really priced off of. So again, my biggest concern is that the same thing happens this time around, that we kick off a new rate-cutting cycle tomorrow with a 0.25 basis point cut, and then the Fed loses control of long-term interest rates. Why am I so worried about this? Because pretty much all the stocks that are hostage to interest rates have been rallying nicely of late. And if long rates start rising again, I think they're all going to roll over. Yeah. Think about the home builders, with the iShares U.S. Home Construction ETF up almost 20% since the end of June. If the 30-year Treasury yield screams higher again, those gains will disappear. Same goes for the automakers, the material stocks, and the non-data center industrials. From my perspective, that could be a disaster for this high-flying market. But how likely is it that we'll get that repeat of last year? Frankly, there are some similarities, but some differences. One of the main reasons I'm worried about this is the simple fact we haven't really defeated inflation. Long rates spiked last year because when the Fed started cutting, inflation heated up again. The consumer price index grew by just 2.4% last September, but by January it was growing at a 3% clip again. And look, the CPI came in at 2.9% in August, the highest level since January. This remains a real problem. That's why when Jay Powell spoke at Jackson Hole last month, he talked about the balance of risk. The Fed has no good choices this week. Inflation's too high, but the labor market's also deteriorating too rapidly for Powell to do nothing. Problem is the bond market doesn't like it when the Fed cuts rates during a period of heightened inflation. On top of that, we still don't quite know what the tariffs are going to do to prices. There's a sense that some companies have been holding the line on prices for a few months, in part because of front-loaded imports and in part by sacrificing margin for the time being. But at some point, those companies might have to give in and raise prices as well. Third, the bond guys worry about the budget deficit, and that certainly hasn't improved versus last year. Many would argue that it's gotten worse if the president's One Big Beautiful Bill Act. When longer-term Treasury yields spiked last year, we started hearing about weaker demand for U.S. Treasuries for the first time in ages. That hasn't been much of an issue lately. But if the bond market starts caring about the budget deficit again, oh, man, that's a real problem. That's why I am worried. Then again, though, this year might really be different. For starters, the labor market seems to be materially weaker this time around. The headline unemployment rate may not be all that different. It was 4.3% in August of last year from 4.1% last September. But over the last 4 months, we've added just 27,000 jobs per month on average. A year ago, it was 110,000 per month. In the 4 months leading up to the first rate cut, what a monumental difference. The weakness in the labor market seems real. And if it reflects some hidden weaknesses in the economy, then we won't likely get a repeat of last year. While I wouldn't call that a good outcome, it's an outcome that will prevent the all-important bond market from going insane. Second way things are different, well, President Trump wants to bring interest rates down by any means necessary. I'm not sure how we can apply pressure to the bond market, but you know what? I wouldn't put it past him. Plus, the action of the bond market a year ago didn't really affect stocks until the Fed stopped cutting rates in December. Ooh, that was the peak. Now that Trump's getting more of his own guys at the Federal Reserve, I think they're less likely to stop cutting once they start. There are also other measures that we could see from the administration to try to push longer-term rates lower. The Treasury Department could start selling fewer long-term bonds, utilizing more short-term bonds to fund the government. That's actually something that Treasury is already doing under Bessent. And they've indicated that they'll keep up the strategy for at least the next several quarters. Maybe that makes the difference. But here's the bottom line. Tomorrow, the Fed's likely to start a new rate-cutting cycle. And while that should be good for stocks, you've got to keep in mind the possibility that the rate cuts just won't work. That's what happened last year. It could happen again. I don't know if it will, but it's something you need to keep an eye on. As long as you're prepared, you'll have a much easier time handling any twist the bond market might throw at us after we get the Fed's verdict. Let's take some calls. Let's start with Jose in Florida. Jose.
Jim, thank you for taking my call. First-time caller. I've been watching your show for the past 20 years.
Oh, fantastic. How can I help you?
Boss, I've been working for Costco since 2002. The last time Costco stock split was 2001. And I've done pretty well. Been buying the stock since it was $27 a share. Now they are $150 a share. But on behalf of the little guys, Costco employees that are new that cannot afford it.
I think that Costco is a great long-term hold. There's never been a moment where it's cheap. And that is something that the late Charlie Munger talked about. He was on the board of Berkshire Hathaway. Never. So my belief is that you buy this slowly. You want to buy 50 shares? Buy 10 here. Wait for it to come down. I think it's a great stock. Don't buy it all at once. The Fed's new rate cutting cycle should be good for stocks, but you have to keep in mind that rate cuts don't always work as intended. They sure didn't it didn't work last year. How about that? Now, there's much more Mad Money ahead, including my exclusive with CrowdStrike. From an acquisition to partnerships with NVIDIA and Salesforce, I'm breaking down all the exciting headlines from the company's customer conference with the CEO himself. Then Bloom Energy has emerged as a powerhouse in the data center build-out, and after soaring over 600% in the last year, did investors miss the boat, or could there be more legs to the story? I'm going to give you my take. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. This week, CrowdStrike's holding its annual Falcon conference out in Las Vegas, which is a large customer event that tends to give you some terrific insights into the cybersecurity business. So far, we've heard about a lot of expanded partnerships, new products, and even an acquisition. What does it all mean for the stock? Let's take a closer look with George Kurtz. He's the founder and CEO of CrowdStrike. Mr. Kurtz, welcome back to Mad Money.
Great to be here, Jim.
All right, so George, just fill us in, first of all, what this conference is like right now, given the fact that the elevation of threats is obvious.
Well, Jim, this is our biggest Falcon yet. We're in Las Vegas. We have to keep moving up hotels. We've got 8,000 people here, over 3,000 different organizations, and they're here to talk about CrowdStrike, how we're solving big problems. And, of course, we're in our expo, which our ecosystem and our partners are a big part of our success. So lots of energy, lots of buzz, and it's fantastic to be out here talking with you.
Now, I found that when I looked through some of the documents and things that you're talking about, I find this theme over and over again, which is agentic security is on your mind. I hope it's on everybody else's mind, because it sure does sound like our whole system is in danger, and we're leaping into a new world, and maybe we haven't thought about the security of the new world.
Well, absolutely, Jim. And let me tell you about the opportunity in front of us. When you look at the company, we're celebrating our 14th anniversary from when I started it. Big part of our success has been protecting humans, protecting the data they interact with, protecting their workflows, protecting what they do. And when we look forward and we think about AI agents, they're just superhumans. They have access to data and compute and workflows and other parts of the network. So protecting what those AI agents are doing is critical. And this is what we announced today, is, and the opportunity in front of us. If we think the opportunity is big to protect computers, it's 100x to protect all the AI agents going forward. And we're in the perfect spot to be able to do that. And one of the big announcements was the acquisition of Pangea, which is a startup company focused on protecting those AI agents. So with Pangea, with CrowdStrike, we think we're in a catbird seat to protect this massive opportunity that's in front of us as AI agents proliferate throughout the enterprise into organizations.
Well, I was looking at an Anthropic threat report, and the bad actors are using AI to imitate in an astonishing way. George, they're able to create resumes. People are hiring the agents, hiring these criminal agents, and they're boring in, and I don't know how you will stop them.
Well, that's part of what we do. In fact, that's what you're referring to as the North Koreans. So AI is being used to create resumes, to create backgrounds, to create LinkedIn profiles, to make it look like a North Korean operative is a real person. And many times the employer never even sees this person. They get hired, they get a computer, and that computer automatically goes to what's known as a laptop farm. And then North Korean operatives access that once it's on the network, and then it's game over. So we found this leveraging some technology we built over 2 years ago called Signal, and we work with our customers, and we find this all the time. But this is what we're up against, and AI is democratizing destruction. It's making it easier and faster for the adversaries to be able to get in and look legitimate, and create these sort of attacks, which is why you need AI to protect AI, and that's what we're doing.
Well, it was glad to see that you're working with Salesforce, because Salesforce has, I think, the most authentic, so to speak, agentics. And the one thing that I'm most worried about is that if you infiltrate something like that, then really you could, banks, retailers, I mean, it could be devastating. But if you're working with them, then I feel much more confident.
Well, and this is what we're doing. They've been a fantastic partner for us, just an amazing company, an amazing partner. And one of the things that we talked about today was Salesforce customers leveraging Falcon Shield. And Falcon Shield is our SaaS security posture management technology, which really looks at the identity of these SaaS applications and AI agents. And that's a key element of how people are getting in. In fact, Jim, just to give you an idea of agents and identity and why it's so important, we have customers now that are actually assigning employee IDs to AI agents. So not only do you have to keep track of them, they're getting their own IDs, and you got to make sure that their identities are safe. And that's what we're doing when we're partnering with Salesforce.
Now, you're also getting right to the source. You're working with NVIDIA. NVIDIA makes it so that the agentics seem very real life. What's that partnership going to be?
Well, as you know, that's the pioneer in agentic technologies, right? So we were partnering with them early on. Big part of what we've done is build out our data science teams. And one of the things I talked about today in our keynote was really being the first company to build an autonomous SOC analyst. Now, if you think about an autonomous car, it really is an autonomous taxi driver or chauffeur. If you're thinking about an autonomous security operations center, it requires an autonomous security analyst. And I mapped out what happens in the car world. You have 5 levels of autonomy, and I mapped that into security, which is now our CrowdStrike autonomous security framework. We're helping organizations get to full autonomy, meaning that the agents will be able to deal with all these security issues, to be able to learn from all of the various techniques in the past, and they'll be able to iterate and get smarter. And one of the things that I focused on, you heard a lot about AGI, right? AGI right. In terms of right?
Yeah.
I talked about CrowdStrike being the first company to get to security AGI. And this is our goal. Now, it'll be down the path, but this is what we're working on with all the big brains and our data science teams. And if you can have an autonomous car, you can have an autonomous SOC with an autonomous security analyst, and that's what we're building and delivering to our customers.
Well, look, I got to tell you, I've been scared, and I remain scared because the North Koreans, these guys are real pros. But you're real pro, and so they ought to go attack somebody else. I think they may be wasting their time. I want to thank George Kurtz, CrowdStrike co-founder, president, and CEO. George, I love having you on the show. Thank you so much.
Thank you, Jim.
All right, talk to you soon. Mad Money's back after the break. It is time. It's time for the lightning round. Quiz rounds and rapid calls. Only same as stock said. Bye. So I don't know the stock much. That's not my staff. Players the questions. Why you planning some? And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Cramer's in. Let's start with Carl in Washington. Carl.
Jim, actually from Virginia, the fun side of the Potomac.
I always thought so.
I once mentioned this company to you while enjoying a sample of your excellent Fosporo Mezcal at Total Wine in Cherry Hill, New Jersey.
Well, I'm signing bottles this very weekend and Saturday in Delaware at the Total Wine and More. I hope to be there again. Let's go to work.
Okay. Globalstar is Apple's satellite connectivity partner and much more. Your thoughts, please.
I have to admit, I have waited for this to happen. And it's finally breaking. Oh, please. And it's finally breaking out. I have got to say, and thank you for Fosporo. I'll see you on Saturday at Total Wine and More in Delaware. Joe in Alabama. Joe,
Jim, I was just calling real quick about a penny stock I bought about a year ago at $1.70, and now it's climbing up mid-60s, or $6. Stock is new gold.
But look, I have to tell you, if it's gold, it's going higher. You know I'm a believer. I've been saying it over and over, and gold's a great place to be. But my favorite is Agnico Eagle. My second is Newmont Mining. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
I got a call yesterday about Bloom Energy, a company that makes novel hydrogen fuel cell systems for on-site power generation that can be used in the data center. You hire them, and they're said to turn around their order in 90 days. Poof, voila, your data center's up and ready. Now, I've always admired Bloom's technology, but frankly, I never thought much of its stock because the company's been a chronic money loser. For years, the stock did nothing, and eventually I stopped paying attention to it. That was wrong. And now we've got still one more reason why. Oracle. If you want to build as many data centers as Oracle's planning to, you need turnkey power, because we know that electricity is the biggest gating factor for these behemoths. We hear it again and again. Data centers burn hot. The grid isn't prepared for them. We heard it from Wendell Weeks when we were at Corning's plant in Harrisburg, Kentucky last week. And we heard it from Bob Pragada from Jacob Solutions just yesterday on our show, which helps design and build data centers. It's the endless refrain traced all the way back to Jensen Huang, the CEO of NVIDIA, who's on a mission to provide more computing power with less energy, although right now that's a tall order. It's all come together for Bloom Energy over the past spring. The company, which has been around for 24 years, suddenly seems like an overnight sensation. You got your first clue that this move was for real late last year, when the straight shooters at American Electric Power announced a strategic partnership with Bloom. This past June, the main power regulator in Ohio approved the first on-site power generation projects in the state, including one where Bloom and AEP will install on-site fuel cells for Amazon Web Services. That's a huge data center company. It only gets better from there, as Oracle signed a partnership with Bloom in July to get power faster, cheaper, better for its data centers. In short, after being a severe disappointment for years, Bloom is now one of the great success stories of this remarkable era, thanks to the strength of the data center. All you can say is to the CEO, KR Sridhar, is congratulations on sticking with it. The company's everything you ever said it would be. This is mad money. How about the stock? Like so many other small caps that provide key parts and power to the data center, it's gone ballistic. Not just parabolic, but ballistic. It's up roughly 230% year to date, going from $25 to $72 since the latter part of July, when the latest deal with Oracle was announced. When I got the call about Bloom yesterday, I recognized that the company had finally exploded on the scene like so many other big speculative winners. My conclusion was a simple one. I missed it. Therefore, it's not my cup of tea. All day, though, I've been wondering whether that's actually true. I mean, Bloom's a $17 billion company now with promising contracts and a pedigree of fantastic technology. Like so many of these data center adjacencies, they're remarkable with lifetime moves in a handful of days. At this point, I think all I can do is wait for a better entry point, though, and console myself with the fact that I've been recommending the blue chip in the group, GE Vernova, to club members. I know that for some of the data center builders, there's still some skepticism about Bloom. I got that from my research, and the caveats are necessary because the task is monumental. I don't know if Bloom is necessarily up to it. It might be so big. In retrospect, just as I blessed all nuclear when Oklo was in the 30s, it's now at $95 and change. I should have said the same thing about Bloom Energy, as well as other novel fuel investments. But after this huge move, I worry about recommending Bloom because I don't want to hurt you. That said, Bloom could be very real. It just happened so fast that I didn't grasp it, and now the easy money's obviously already been made. So many doubters have surfaced of late about this theme. I was skeptical, too. Still, tired as it sounds, I think you have to wait for a pullback for Bloom, like the one nuclear is experiencing right now. And admit, darn it all, with AEP's endorsement, I should have recommended Bloom Energy to you. I didn't. My bad. Let's get the next one. I like to say there's always a bull market somewhere. I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer, and I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.